Okay, we'll go ahead and get started. Hi, and welcome to the Open Air 2022 second quarter recap. My name is John Lawton, certified financial planner with Open Air Advisors. I'm joined today with Chris Massenberger and Stuart Fields, and basically we'll be going through our recap of quarter two. Now, our agenda for today is number one, investor challenges in the current market environment. Number two is just a historical perspective on what we've seen and basically the challenges that we're going through today. Number three is the impact on volatility. And so at this time, I'm going to turn it over to Chris Massenberg, the 2022 Living Magazine Reader's Choice Best Financial Advisor. So take it away, Chris Massenberg.
Thanks, John. Welcome, everybody. So as John said, we got a couple of things we're going to tackle here today. So first, let's take a closer look at some of the challenges in the economy and what we're seeing. So first thing we want to talk about is inflation. And this is a hot topic, obviously, because inflation has gotten high and it's persisted. So it's surged really to the highest levels we've seen in 40 years. And so you'll hear that a lot, this Consumer Price Index or CPI. So what they're talking about, and that level just rose to 9.1 was the latest reading in July. Over the last 12 months. And so you'll see this first graph here. So what they're talking about, and to give you an idea and show you just that graph comparison on where we were last time it was this high, you can see that graph goes back to about 1954 all the way to today, July 2022, where that level is at 9.1. So last time we saw inflation levels this high was in the early 1980s. Okay, so early 81, 82 is when it started to decline and get to that point. So this is a major concern, obviously, because things are getting more and more expensive. And you can see to the right, just in the last 12 months, some of the challenges we've seen when it comes to oil, for example, 80% increase. Gasoline's up 43%, used cars 22%, beef 14%, milk 15%, housing nationally is 16% climb. Here more specifically in the DFW area, it's probably closer to a high 20, maybe even 30% increase year over year. Me and my family just went through the process of looking for and purchasing a new home this summer. So I can tell you the prices last summer compared to this summer are closer to that 25, 30% climb. So that's what they're talking about when they say CPI. So that's why the Federal Reserve is going to get involved. And we'll talk a little bit more about that here in just a few seconds. But those prices continue to increase and that inflation continues to be persistent. So we've got to get that under control. And that's driving a lot of the cost increase, though. So the next thing that we want to look at is what's really contributed to this inflation. And so one of the biggest factors is the monetary supply. So money supply or money that's in the economy. And believe it or not, about 40% of the monetary supply that's out there has just been created since the last 2 years, from January of 2020. So we had this increase in the Federal Reserve balance sheet where they took on all this new debt. Okay, the Federal Reserve was buying debt. Then we had the total fiscal stimulus, those stimulus packages in 2020 and 2021 for a total of about 5.7 trillion. So just under $6 trillion was added to that national debt. And that really increased the money supply. You'll see on the right-hand side, from 2020, you can see that line just goes almost in a straight upward direction because we basically took all the money we had, 40% of that and added it right on top. So when there's more money out there, there's more money to spend. It's a simple supply and demand scenario where you've got limited supply, lots of demand because people are more cash flush. So that's really what's kind of helped drive the prices and continue to keep that inflation persistent and pesky. So the next thing we really want to look into is, the economy and how it's done since 2020. And the way that they measure the economy is in GDP, gross domestic product. Okay, so when we look at this, it quickly recovered. If you look at that chart right there in the middle, it quickly recovered. In 2020, you saw that big dip of 31% decline. And then by Q3 of 2020, the economy had that rapid growth right back up to 33, almost 34%. And then it kind of got back to normal levels by the end of 2020, 21. And then it started to decline just this year. So the latter half of last year, Q4 of 2021, you started to see that supply chain issue where things were getting jammed up at the U.S. ports. And so supply became a big problem. And so that kind of contributed to this growth really slowing rapidly. And we had our first negative quarter in Q1 of this year of a negative 1.4% decline in gross domestic product or in GDP. We just had our most recent reading for Q2 come out in July, and it was another negative of 0.9% growth in that GDP. So by definition, 2 negative quarters in a row of GDP constitutes a recession. Now, depending on who you talk to, the definition of recession, that has been the definition for years. But a lot of people think that this is a technical recession. And so that's why that argument is out there, is because we've had these 2 negative quarters in a row, which is the definition, but they think that they're driven by this supply chain. However you see that, the economy is slowing, and our GDP has gone negative twice in a row. And so that is a technical recession. Okay, so a couple of things that are on the positive and why we're getting mixed signals is because unemployment. So if you look at the graph to the right, the unemployment rate has steadily declined. We had that high in April of 2020 where almost 15% of the country was unemployed. And then we started to steadily put people back to work. So as of April, it was 3.6, and then it's July, it's still at 3.6% unemployment. A recent study came out and said that there's about 2 jobs available for every 1 unemployed person out there. So it's not a matter of jobs being available, it's a matter of filling those jobs when it comes to unemployment. So as that continues to stay low, that's good for the economy. We want people working, earning money so that they can go out and spend. Okay, so I talked about it a little bit just now. So the supply chain disruptions, that's been a challenge ongoing. For those of you that were around last December, when we did this quarterly review, we made a joke about having to go from cargo ship to cargo ship to do your Christmas shopping because everything was jammed up at the ports. That continues to be a problem. You know, I speak with many business owners. Being a business owner myself, I speak with business owners all the time. Just about everybody I know is trying to hire people right now and having a hard time finding parts and supplies. So that continues to be a problem. And again, we go back to supply and demand. Where there's not enough supply, but there's heavy demand, it's going to create all these issues. And so a lot of times we're having problems getting these parts and these supplies into the country. And that's really jamming things up. And then you also have the opposite effect. So recently there's been an inventory study that came out that said that a lot of these major corporations, because in December it was hard to get products. What do you think everybody did in December and January and February? Well, they double and triple ordered supplies. So now they've got double and triple inventory on what they normally have. And so my hope is that all that extra inventory going into Q3 and Q4, maybe you'll start to see things come down as far as price goes. You might see some things go on sale come holiday season because the inventories are way higher than they should be. Then geopolitical, obviously we talk a little bit, everyone should be feeling this at the pump, unfortunately, but the geopolitical events that have taken place throughout this year have really had a high impact on energy and oil. So with Russia, obviously, and their choice to invade Ukraine earlier this year, and about February, really that saw the geopolitical risk in the oil and gasoline markets really take off as far as price goes. Now, we saw a lot of that decline leading up to this year, and then all these geopolitical events really helped drive that number up. So we're seeing gas prices, they were surging all the way through June. We've started to see those to come back down a little bit as we increase supply and kind of get some of this stuff worked out. Those prices should level off or even come back down. So in the event that something turns around on this Russia-Ukraine deal, those prices should drop significantly. But that's what's been driving a lot of that cost. The other thing that we talked a little bit about, obviously, was the Federal Reserve. So in case you haven't heard, the Federal Reserve is raising interest rates. So the Fed funds rate, they've been signaling since the early part of this year that they're going to raise rates. And the reason that the Federal Reserve raises rates is really, it's a tool they have to help cool off the economy. So when the economy gets too hot, inflation gets too out of control, the Federal Reserve can use that tool of hiking the Fed funds rates, and it will, in turn, in theory, it's supposed to help curb inflation. So you want to slow down the economy. It's growing too fast. Inflation's out of control. And that can have an impact on mortgage rates and trends. So you see the graph here on the left, the 30-year mortgage is in the purple, 15-year ARM, and the 15-year fixed, and then the 5/1 ARM. You can see those rates have been steadily increasing throughout the year, and peaking really early this summer and starting to come back down a little bit as well. So as the Fed continues to raise rates, you might see this fluctuation in pricing. You can see the chart or graph there on the right, the 30-year mortgage, the 10-year treasury yield. While they're not directly linked, they are correlated as far as the way that they move. So as those long-term treasury rates go up, typically so do mortgages. So that's what you're hearing a lot. So, and we're gonna have a little bit on this too, I think, on the next slide here. This will kind of give you an idea. Well, what does that mean? The 30-year mortgage moving. So it's a higher borrowing cost for basically to slow the economy on the housing market as well. So you can see if you were going to buy a home last December, the average 30-year mortgage was about 3.1 or 3.11%. Your monthly mortgage payment on an average medium home price of 428,700 was about 1466 a month versus 729 or at the end of the month at 5.3%. The same home, same price, but that mortgage payment was about 1893. So you got a difference there of about $427 or an increase of 29% as far as just the monthly payment goes on the mortgage at that price, just because interest rates have changed so much. So that's a little bit on the economic front, what we're seeing as far as the market goes. At this point, we'll go ahead and turn it over to Stuart Fields. He's going to talk a little bit more about the Federal Reserve rate hiking cycle as well.
Thank you, Chris. That's definitely, you touched on some good things. That's kind of hitting home as people start traveling again, and then with the cost of plane tickets becoming really more expensive and basically fluctuating, especially with all geopolitical events. What we have in the background, or maybe the foreground, is what is the Fed doing? So one thing that I'm kind of keeping an eye on, and our investment team as well, is just basically, what is the Fed doing with rate hikes, and how will this affect portfolios, not only in the short term, but how does this help us react and be more proactive in how we set these portfolios to perform headed to the next 3 months, 6 months, and 1+ year out. So there's been definitely a lot of things to follow. And so if we start going back to the last 75 years, basically the Fed raising rates is not something that is brand new. It's something that's been done many, many times. And while we don't really know what's going to happen in the future, we can use this to help educate our clients and give them the knowledge to make really good decisions, and hopefully that they feel really comfortable about where their portfolios are now and where it's headed. So as we kind of look at this chart, what we'll see is really here in the blue, we'll see the federal funds rate. And then the orange, we actually see the CPI, our consumer price index. So kind of think of that as inflation. That's kind of what the headlines will call it. And as you see the blue and the orange, that they're pretty much directly correlated to one another. And because of that correlation, it's no coincidence, is the Fed will tend to combat inflation. So when inflation basically becomes to increase and get at abnormal levels, they're going to combat that with rising rates. That's going to kind of slow down the economy, like Chris was talking about, in hopes to start cooling off inflation, which we might over the last 5 to 6 days, maybe got some good news about inflation really beginning to cool, and we'll touch on that here in just a second. So again, when we do see inflation beginning to increase, we do see the federal funds rate begin to follow with it. And so what does that mean with our markets? What does that mean for our performance? Is that a good thing or a bad thing? So many people would jump to a conclusion that when the Fed is raising rates, that this must be a negative thing for our portfolios and for our equities. But fortunately, that observation is not true. In fact, 11 of the last 12 times that we've seen a interest rate hike, which is also referred to as the federal tightening policy, 11 of the 12 have actually been positive. It really isn't until 1971 that we see in this range, where we saw about a 13% decline over that about 3-year period. The other 11 has actually done pretty well. And if we go to the last cycle, which started at the end of 2015, if you remember, 2008, 2009, of course, was our financial crisis, and we saw a lot of financial easing over that 5-6 year period. So it really took them about 6 to 7 years before the Fed started raising rates again to say, hey, okay, we've let out enough time to recover from the financial crisis to begin to raise rates again. So from about 15 to 18, almost right before the pandemic, our country was raising rates kind of aggressively, yet we did pretty well. Over that 3-year period, our markets basically returned over 22% return. So again, not saying this is going to happen in the future. It clearly hasn't started this way in the first 6 months of the year, but something to kind of keep in the back of your mind as we don't want to try to time the market. We want to really start putting your accounts, your assets into positions that really, no matter what the market does, is that we can kind of keep you guys on path. Because I know myself, John, and Chris, we never want to get a call from any of our clients where they've lost too much money, that they're uncomfortable, because it's that point when people really start making bad decisions. So we never want to get our clients to that point. So again, that's where really good ongoing conversations is a really big goal of ours, kind of like these webinars. Kind of moving on really quick to the next slide is, well, one of the biggest questions I'm getting right now is, well, are we in a recession? And Chris was kind of touching on it. There's a big question mark on it. It's highly debated right now. Believe it or not, there is a group that has the power to officially call if we're in a recession or not. So we have a technical definition of 2 negative quarters of declining GDP, but we do have an official group who gets to say whether or not the United States is in a recession or not. And so far, they have not declared us inside of that recession. So with that being said, if we kind of go back to really the Fed's funds rate, which we'll still see in the blue, we'll basically see in the gray area, these are the areas where we have actually been declared as an official recession. So, if we start looking at this, 8 of the last 12 interest rate hiking cycles, we've actually gone into a recession. We might be in a recession right now, or we actually may have already been in one kind of coming out. So those are the one things that we'll look at. I know John's got some good stuff that we're touching on, because we don't want to time the market. The S&P could very well hit 3,300 the next 6 months, or we might end the year at 4,400. So I believe, as a good steward of money, we've made some really good decisions that we're not banking, and we don't have to be right for you guys to be really happy and confident in your plans kind of going forward. So, this is, on the reviews I've had with my clients so far over the first 6 months of the year, one of the common themes that we're talking about is, and something that we've talked about for years at our educational events and at previous webinars, is how we learned to diversify our portfolios 10 years ago, 20 years ago, 30 years ago is not the same way that we need to do it going forward for a couple of different reasons. And the biggest reason is this. What this is showing us is how poorly diversified portfolios have struggled this year. And I'd like to pause there just for a second. And because, just because something has performed poorly doesn't mean that we need to abort ship. We're going to make changes to things, whether things are doing great or basically underperforming. But a couple of things to point out of why you're looking at portfolios, or maybe colleagues and people around you are talking about them losing more money than they thought that they would. It's because of this. If we look at, to start the year, the first 8 months of the year, the S&P 500 is down 14.2%. So that may not surprise a lot of people. What might surprise a lot of people is this number right here. And what we're looking at is basically the aggregate bond index. So for the people who like to follow, what I'm talking about here is AGG. AGG, which kind of tracks the performance of all the domestic bonds here in the United States, is down about almost 9%. So many people were under the impression when stocks go down, bonds will go up. That hasn't been the case this time, hasn't been the case a lot of times over the last 4 to 5 years either. So again, if you have this traditional approach and you're very over allocated to bonds, you haven't really done that well. So most portfolios that have kind of used this approach are down about 12% to start the year, which kind of is broken down right here as well. So that's one of the biggest reasons why, and the reason why bonds have struggled is because of inflation and the Fed raising rates. Typically, you're going to see a negative correlation between the Fed raising rates and the prices of bonds. They're usually inversely related. As bond prices or interest rates go up, bond prices can typically go down. But again, over the last couple of weeks, couple of days, we've actually seen this kind of reverse. So we do see that There is hope for bonds in the near future where, we don't like losing 9%. And by the way, we've decreased our exposure a lot to these mid to long-term bonds. So our bond portfolios have tended to do a little bit better than what I'm showing you. But any of the losses that we have seen in this space, we should hopefully get a recovery in the next, few months. But again, that's a lot to be determined based off what happens geopolitically and overseas. One of my favorite two graphs I wanted to go over is coming up, and that's really this. And really what this shows us is well, how do we recover from here? How does this start compared to some of the worst starts we've seen, over the last, 100 years? In fact, on the equity market, this is the third worst start we've ever had. And so again, 1932, of course, is, the worst, followed by 1939. And this is kind of where we're at right now. And so with that is we wanted to look forward to find out when we get off to a bad start, how long does this bad start typically last for? And so if you look at this chart on the right-hand side, this will break down what the performance was in the first 4 months of the year. And then what happened over the next 8 months and the next 12 months. And what you're going to see are some really positive signs and some really positive numbers. If look at the worst start, when the market started off 27% down, the next 8 months, we got a 26% recovery. And then over the next year, we got a 54% recovery. So that's just pretty much the common theme over here is we're seeing some very healthy double-digit returns for the most part, but not always. And so again, we do have a plan in place if we do continue to see the years get worse and worse. So we've made some proactive decisions back earlier in the year. We're still going to make some decisions going forward that John's going to touch on. So again, just because we get off to a poor start doesn't mean that we have to be in this for the next 2 to 3 years like most people think. And then this is something, so we just talked about equities and what that means kind of going forward based off, what's happened over the last 100 years. But now let's look at bonds. How have bonds recovered? And this actually is pretty eye-opening. And this talks about how have bonds started off in a year compared to the last 100 years. This is actually the worst. And it's been the worst by far. So, we've gotten almost down to a 9.5% decline in bond prices to start the last, the first half of the year. The second worst start was 1994 at 3.6. So that's almost 3 times worse than any previous period that we can find. So how did that perform over the next 8 months and the next 12 months? Well, kind of like I said earlier, is quite well. You see some really healthy returns over the next 8 to 12 months. So just because something hasn't worked out doesn't mean that we want to abort it because that's, the famous selling low position. So we do want to be long-term investors. Anything that we own in our portfolio, we really do like over the long terms, but things change. The allocation levels will change. The weightings will change to make sure, depending on what the Fed does, depending on what happens geopolitically or around a midterm cycle, that we have you guys in a strong position to, to really make sure that we can do our jobs the best way that we can. So again, this is something that I know John and Chris have hit on over with their clients over the last several years as well. So as we knew this day was coming, so we knew that bonds, that interest rates couldn't remain at 0% forever, and that when interest rates go up, bonds will go down. So we've seen that happen the first 7 to 8 months of the year. We've seen them, take a steep decline, but we expect that probably still to trend that way as we're facing record levels of inflation. So interest rates are near historical lows still, even though the Fed has raised rates 3 or 4 times, with probably at least another 3 or 4, to go throughout the year and next year. Is basically we're not generating, or bonds generally, not our portfolios, but generally bonds are not creating a lot of yield or income from their portfolios because we're at historical lows. The second thing is why they're going to face some challenges is because when yields go up, prices will go down. Typically, there's some times that they can go in the same direction, but for a general rule of thought, you want to know that you're going to have some serious headwinds when the Fed continues to raise rates. And of course, inflation. What we're after for our clients is purchasing power, is real growth. If you're making, let's say, inflation, let's say over the last 12 months is 9%. If you're making anything less than that, you're losing purchasing power. So again, if you're into low yielding fixed income, you own a lot of them, you're going to lose purchasing power. So again, owning a lot of these assets that are tied to interest rate movements can help you or make you lose more purchasing power. So we want to be a bit more proactive in that area so that we can keep up with inflation, that we can have real growth inside of your portfolios. And then so the same thing with equities. So, if we start looking at kind of quickly where we're at, if you look on the left-hand chart, you'll kind of see how the S&P 500's reacted since 1997. And what we see here is 2002, this first arrow. This is when the early 2000s and the dot-com bust. It took us about 5-6 years to make all those losses back, but we eventually do right before the market crashed in 2008. And then basically down here, we saw a lot of monetary policy that was very favorable to economic recovery. And we saw this, one of the best bull runs we've ever seen. So we're sitting here at kind of, early January, literally at all-time highs. And, we're down about 14% from there. So when we look at basically where we are, do we think that there's going to be a lot more momentum going forward? That's a tough question, but historically, I think if we start looking at our price to earnings ratio, we're kind of getting up there. So we do think over the next 2 to 3 years, our real rate of return could be a little bit lower than historical. So that's why I think not using more by the book approaches is going to be something that you really want to work with your advisor to find out. If we do expect lower rates of return for the next 2 to 3 years, how can we make sure that we stay on track? The good news is, and I can to attest for this, is that most of our modeling, when we build retirement plans and financial plans for our clients, we use a very modest rate of return, very, very conservative, to tell you the truth. Most of our portfolios on a return standpoint are kind of expecting somewhere between a 5.9% rate of return. A little bit lower in some cases, but a little bit higher. But our average is about 5.9. So historically, the market's going to return somewhere between 7 and 8. So we want to be conservative when we're basically modeling and we're forecasting, whether or not you have enough money to live, how much money you can afford. We don't want to use these large gangbuster rates of return. So even if we do see lower historical returns over the next couple of years, our models have already priced that in. So the conversations that we've had for the last 3 years, 5 years, some of the clients, over 8-10 years working with you guys, that's going to be already inside those models. So that's going to be really, really important for you guys to know that we are using conservative returns when we start looking at modeling and giving you advice about the next, 10 to 20 years of your retirement period. So hopefully that kind of fills you in with what we're seeing in the equity market, the bond market, how that's related to the overall movements of the federal funds rate. There's going to be a lot more to come, a lot more things to pay attention to. So we're going to do a good job as a firm getting that information out to you so that you guys feel comfortable and have the knowledge to make really powerful decisions in the future. That being said, John's going to touch on some things that we've made, some changes to our core portfolios, and basically what we kind of expect going forward.
Great. Thanks, Stuart. Go ahead and click through. So this is our portfolio rebalances. And coming into this year, so we had a wonderful year last year, and then coming into this year and knowing where we were in bonds and fixed income. And I'm going to use bonds and fixed income. They're synonymous, they really mean the same thing. But coming into this year, just like Stuart mentioned beforehand, we really shortened the duration on our bonds. The reason that we did that is interest rate sensitivity. So if interest rates go up, the longer the bond, the more they're affected by that interest rate sensitivity. So we shortened our bonds. We went as diversified as we could go. We got into high yield, emerging market debt, and really went as diversified as possible. We did the same thing with our equity, really trying to make sure that we took advantage of this market, but also trying to protect and be diversified for whenever the market did finally take a breather. This last rebalance that we did in June, we reduced our equity exposure by 2% in favor of fixed income or bonds. And really, when you look at that, what that's telling us is all we did is we took our portfolios back to neutral. So I get this question a lot. How often do you rebalance your portfolios? And a lot of folks, a lot of investment advisors that you talk to will say, well, we rebalance 4 times a year. We rebalance every quarter. Here at Open Air Advisors, we don't rebalance every quarter, specifically because I'll just tell you, I'm an opportunistic rebalancer. If there are things that are doing well, sometimes we want them to get out of, sometimes we want them to continue to grow. Whenever there's different challenges in the market, we've rebalanced more times this year than we did all of last year. So that 2% rebalance back into fixed income brings us to our income and equity exposures in line with historical benchmarks. So where we let our equity last year kind of get out of bounds, we really brought that back this year. Within equities, this last rebalance, within equities, we reduced our international exposure in favor of more domestic. Our portfolios today are more US based, more domestic than they've ever been. We see, obviously, with the Ukraine, Russia challenges there, I think that Europe is probably going to have a much more difficult time going through the next 6 months than really the US are, or than us here are going to have. Also looking at Taiwan, China, that's another one that's starting to pique a little interest here as well. For our portfolios today, we've decided to just be more domestic. Within fixed income, our credit exposure is been reduced, given the potential for future widening. This last rebalance, so like I said, at the beginning of the year, we went really diversified. We added emerging market debt. We added a lot of high yield. We shortened the duration in our bonds. The April rebalance, we took our duration back out to where it's more benchmarks based, where it's just further diversified through the duration. In this last rebalance, we completely eliminated emerging market debt and high yield debt there as well. So those pieces that we were using to diversify at the beginning of the year, we've taken out of the portfolios now. So getting the overall duration of the portfolios more in line with historical benchmarks. Go ahead and click. In April, Stuart and Chris both alluded to this earlier. You saw stocks and bonds fall equally. The longer duration your bonds, the farther they fell, equity-wise, just depending on your makeup, the more growth-oriented, the farther those fell. So we saw correlation there. Things that are not supposed to be correlated this year were correlated. I lived through 2008 and was managing portfolios in 2008. All of us were managing them in 2020. During those time periods, especially in 2008, if you called me and said, John, I'm concerned about this market, make me more conservative, what I would have done is I would have turned down your portfolio, would have sold some of the equity in favor of buying bonds. This year, that would have hurt you. And so across the board, whether you're the most aggressive investor or the most conservative, because stocks and bonds are correlated, they basically moved in sync. And so we decided that there needed to be another way. We decided there needed to be another solution out there. And so we implemented something called a buffered ETF inside our portfolios. And basically what we did is we bought some protection to the downside for a portion of the portfolio. And really what we're looking for, and this is in March when we were looking at this, what we were looking for is something that would help further diversify the portfolio, help protect it on the downside, but give us potential for return whenever the market does come back. And so here again, if all we did was push our money over to bonds, whenever the market does recover, how well will those perform? Well, you saw the numbers earlier with Stuart, and during across different time periods, bonds did have a good recovery time period. Equities usually do better during that time period. So, but bonds really haven't protected. And so using a buffered ETF, what that allowed us to do is, in the details, just know this is an ETF that's being traded every single day. So depending on where you bought it and how it was purchased within your portfolio, the numbers will change a little bit. Essentially right now, you've got about 28% buffer to the downside with about a about a 29% buffer with help me here, guys. I'm trying to read. I'm having trouble reading this. Usually it's about a 13% cap on the upside with about 25.
It's 14.5% roughly.
Okay, I'm sorry, I'm struggling to find it here quickly. Say that again, Stuart.
14.46.
So a 14.46 cap, and how much buffer do we have?
24.93.
So we're going to buffer to the downside by 24.93 with that 14% cap. We feel like this is a good trade. This trade will last until January. So just know for this portion, there we go. There it is on my screen. It's very difficult to see that for whatever reason. Just know this trade will go until January. So during this time period, we've got this trade live. The investment committee, myself, Chris and Stuart, are going to be looking for solutions beyond January with what to do with that allocation, because when this resets, the beauty in this trade is that we bought it after it was issued. It issued, the market traded down, which made our numbers more favorable. And so that gave us an opportunity, one that we don't see very often, one that gave us immediate downside protection with a really nice cap to the upside. And so that'll be something that we're continuing to explore through the end of the year. We'll be making decisions probably sometime in December or January with how we will change that portion of the portfolio. Let me just say this, on a webinar, I mean, we could do a webinar specifically about this one position and go into massive detail. I would reach out to your advisor specifically if you want more information or details on how this trade works. It's relatively complex, and I feel like I'm going to get lost in the woods if I go down if I try to explain it too much. But reach out to your individual advisor, and they'll be able to explain how the trade works. But it's given us a level of protection on our portfolio. But as the market does recover, should do very well there as well. And so here again, a lot of folks talk about, oh, we want to move to cash. We're scared of this market. What we're looking for are opportunities for us to protect, but also gain whenever we do recover, because eventually this market does recover. When it does, it happens very quickly. We want to make sure that our clients are taking advantage of that as well for when this thing does turn around in the right and meaningful way. So with that, go ahead and flip to the next slide. Some key takeaways from today's conversation. Inflation's at a 40-year high, top concern for a lot of Americans. We see evidence just in oil prices. I'll tell you, I filled up my tank for under $3.50 today in June. That average price across the US was over $5. That permeates everything from everything that we buy in the grocery store. That's starting to come down. That should be a good sign. We don't know where it goes from here. Obviously, I don't have a crystal ball, but it does look like maybe that's starting to come down. The Federal Reserve has begun to raise interest rates to slow inflation. Higher interest rates are expected to slow down the economy, which asked, are we in a recession or not? Hopefully what the Fed is looking for is a soft landing. We certainly expect that. We hope that happens, which means that we don't plunge ourselves back into some of the recessions that you remember based on years. Geopolitical risks have increased market volatility. You guys have seen that with Russia, Ukraine. That's also that oil thing we just talked about, grain prices all the way through. Diversified portfolios have struggled in this environment, but your team of advisors here at Open Air are looking for innovative ways to navigate the market, solutions that will help us both protect and give us potential for upside in the future. You're looking for additional solutions to meet your long-term goals, and so that's what we're accomplishing here at Open Air Advisors. Go ahead and go to the next one. Are we going to open it for questions, or are we going to?
Yeah, so I see one. So one question that I get a lot, and I'll go ahead and answer this one, John, about UGN really quick. It's about volatility control. And so kind of going back to what my part was talking about, really, when you get off to a poor start, and let's say that, returns are down, it's really what we're really proud about, how is basically managing volatility into a way that we can constantly add value. Going back to UGN, which is what John was talking about. Like if the market goes down 25%, that UGN position, which is roughly 25 to 30% of a lot of people's portfolios, if the market goes down 25%, you got to realize that you don't lose a dollar in that position if we hold it till January. So another, basically 4 months. But the great thing about that is is we're able to sell it. And again, in this example, if the market went down 25% at no losses, that allows us to go reinvest that hasn't lost any principal into basically a sea of investment opportunities that could be down 25+%. So that's really good value and something that's going to help us recover portfolios from any losses. We don't like losing. Portfolios will go up and down, but right now what we really want to focus on is making sure that you have purchasing power, and purchasing power does come inside of a when you have a choice of like, I didn't lose nearly as much as the market. I can now get out of this asset class and go buy something that is down 30, over 40%. That's what we want to give you guys the option to do, so that when you do have those poor starts to the year, that we can get back to basically even as fast as possible, then we can start growing the portfolio again. So I think that UGN portfolio is going to be a really good spot for us to do that, to add some uncorrelated returns and to give you guys a lot of purchasing power if the market does indeed go down, more than it already is. So good question. And if you guys have any more questions too, feel free to use the Q&A box. Raise your hand. We'll unmute you and we'll answer those questions, and we'll get you taken care of.